Hi everyone, my name is Maija Ehlinger. I'm editor-in-chief of Hypepotamus. We are a publication covering tech startups, entrepreneurship, innovation, and the venture capital community here in Atlanta and across the Southeast. It's my honor to be the MC for this deep dive track into the future of commerce. Obviously, commerce and where we're heading next is something that impacts each and every one of us as consumers and the business leaders making decisions for the future. In this room today, we're going to be talking to CEOs, technologists, and the operational leaders that are making the decisions about how you as a consumer purchase things and how business owners connect with their consumers, both in the e-commerce world and in the brick and mortar shops. So a couple pieces of housekeeping before we get going and talk with our amazing group of panelists. I hope by now you've downloaded the two most important apps for the day, one being the Fintech South mobile app, where you can see a list of who's going to be speaking next in this room and in all of our other deep dive tracks. Second is I hope you've downloaded the Brain Date app for opportunities to network and mingle with other participants here. And throughout the day, I hope you've also been able to check out the more than 50 plus companies that are up in Innovation Alley. You can get a good sense of the type of companies that are here building in Atlanta and around the Southeast, and those that have come in for this discussion today. Today, here in this room, we're really appreciate that we have Elavon as our sponsor. We couldn't do it without the support of our wonderful sponsors here. So before we kick off the conversations, I wanted to invite Melissa Schmidt, who is SVP over at Elavon, to tell us a little bit more about your work.
Thank you everyone for attending the Future of Commerce track. I'm Maija Schmidt, and it's POS lending for Elavon and US Bank. I'm studying marketing in that product. And for those of you who don't know Elavon and US Bank, Elavon is one of the world's largest payments providers, and we happen to be a part of the payments division of US Bank, one of the world's largest banks. So it does give us a lot of breadth and depth of experience and regulation savvy and all of those good things, so that we can work together to grow their business. You wouldn't be here today if you weren't like me and really interested, not really where we are today in the industry, but where we're heading. And so, in my opinion, I think the future of commerce is bright, as they say. Commerce is the engine of, with the oil in the engine of the economy. And we're going to hear today from very smart people in the room who may or may not have a crystal ball. If anybody does, please share. But I think we'll walk away at the end of the day kind of just a little more enlightened, different perspectives to take on, and bigger challenges to come together. So thank you for kicking us off, and thank you for attending. I'm going to hand it back to you.
Thank you so much, and yes, thank you, Elavon, for sponsoring today. Note to any speaker, yes, if you have a crystal ball about what is going to happen, please share it with us. We want to hear. On that note, we're going to kick off our first conversation today about seamless payments and customer loyalty. The two people that we have up on stage have really interesting perspectives to share with us. We're really excited to have them on the stage. I'm excited to to introduce to you Jay Clarke, Director of Operations at Southern Proper Hospitality Group, and Caroline Ward, U.S. Sales Manager for Sunday, startup with roots here in Atlanta and in Europe. I'll let you both take it away.
Awesome, thank you so much. And I'll disappoint to start off, I have no crystal ball. Maybe Jay has one that he can share with us. But I'm Caroline. I'm super honored to be here today and grateful for all of you for coming to our little party. I'm the U.S. Sales Manager of Sunday. And hopefully, if you're from Atlanta, you've had the opportunity to use our payment solution at one of your favorite restaurants. But if not, we are the leading pay-at-table solution for full-service restaurants. We were founded in our founders' in their restaurant group 2.5 years ago. And we were founded out of a problem that they saw in their own operations, a gap that came when one party was ready to leave and the other party was ready to sit down. And in that moment, the experience in the restaurant deteriorates, and there is a potential loss of revenue for the restaurant. And so they put Sunday in their restaurants, saw great impacts to table turn time, increase in spend per head, increase in tips, and a ton more feedback from their guests. And so they rolled it out as a separate company from there. And in the last 2.5 years, we've been able to raise $125 million. We have partnered with thousands of restaurants across the US, the UK, and France. And we've partnered with the leading POS systems in each of those markets as well. So in the US, that means Toast, Aloha, Clover, Micros, and the list goes on. But we work with all of them and have been recently chosen as Aloha's preferred pay-at-table solution, which is super exciting for an Atlanta startup. And so we're headquartered here in Atlanta, like Maija mentioned. Some of our partners here include Buckhead Life Restaurant Group, Castellucci, Del Bar, and one of my favorites, Southern Proper Hospitality Group. They were an early adopter of our pay-at-table solution. And hopefully you found yourself with a margarita at Ten Lizzie's or some hummus at Gypsy Kitchen, oysters at the Big Catch. They've got lots of fantastic concepts. And Jay, I'll let you introduce yourself and tell us a little bit more about SPH.
Thank you. Hello. I am a restaurant adventurer. I like adventures, and they're not all good. But the restaurant industry has provided great adventures over my career. I started with Houston's restaurants, and I learned how to be a restaurant manager right out of college. Spent some years with them and got the foundation of high standards. And I went to France. I worked for a Atlanta themed restaurant in Toulouse, and I kind of learned the history of restaurants and the spirit of it. And when I came home, I started working for Wolfgang Puck, and I learned a lot from a chef like Wolfgang Puck. So my career has taken a curvy road. I've worked for Bar Taco right after COVID when we started the QR kind of service revolution at Bar Taco. And I spent my whole career trying to run good labor and make people happy. And my crystal ball, by the way, only works for football scores. It's looking good for the dogs.
Awesome, thank you. And like I mentioned, Southern Proper was definitely an early adopter in the Atlanta market. And when we think about payments and technology in the hospitality industry, across the board, hospitality lags a little bit behind from a tech perspective. And so when we think about seamless payments, there are a number of industries that have really been revolutionized already by seamless payments. When we think 10 years ago about the first time that you got in an Uber, that was wild at the time, a totally magical experience. To not take your phone out, to not exchange a credit card or cash as a result of the ride, and weird at the time, but now if you think about pulling out your credit card in an Uber or making a phone call to get a ride, that feels weird. So a huge change in a short time. When we think about flying on a plane, think about the first time that you didn't ever wait in line to check in. That's really weird, but it saved you a whole step in your experience when you were at the airport. Airbnb is another great one. I can now book my stay, pay for my stay, check into my stay, and enter my stay all through my device. And so that's really what we want to do at Sunday for the hospitality industry, is to take this waiting experience and turn it into a 10-second, delightful, maybe magical payment experience that drives value for the restaurant operator as well. And so when we think about what that looks like, that means being able to scan a QR code, split the bill as many ways as you want, Apple Pay, Google Pay, and then get up and go and have a full integration with the restaurant's tech as a part of that. And so thinking about the hospitality industry again, Jay, what do you feel like are the reasons or the hesitations that the industry has had when considering taking on a digital payment solution?
I think that restaurant operators are creatures of habit in some sense. Every week across our country, you have restaurant managers like me walking around with clipboards and paper and pencils and counting inventory. And there's a lot of technology that would do that for us, and we just resist it. In part, it's cost. We're running very lean margins, and so anything that adds to our cost base, we're reluctant to accept it. And part of it, too, is the service culture. When I'm serving somebody, I'm taking care of their needs, and payment is one of those needs. So it's hard to give it up a little bit to the system. So in my view, I think that it's such a long, deep history of restaurant operations that operators don't want to let go of the things they can hold in their hands with a cup of coffee.
Okay, yeah, that totally makes sense. But you guys have decided to do that in some ways. And so take us through kind of the guest journey as it stands today, and where you've added technology to drive that experience and increase customer loyalty, where you've been intentional about not adding technology, and then also where you feel like there might be gaps, where you would add technology but you haven't found the right thing or the right thing at the right price or whatever it may be.
Well, Southern Proper is an Atlanta-based company. There's 3 main partners, and they're entrepreneurs first. They're entrepreneurs before they're restaurateurs. So they're very open-minded, and we went running to Sunday. It's been a great opportunity for us, and what's great about it is how seamless it is, how easy it is, and how good Sunday is really. The payment structure is safe. It gives us so much in terms of the ease of information flowing from a person's device to our point of sale system. It almost seems like it shouldn't work the way it does. And it gives us more room on service levels so that we can reduce our payroll a little bit. We're faster. The guest gets what they want super quickly. It just really works. And we're using technology in many aspects. We use technology behind the scenes for reservations with a software like OpenTable, which is very, very smart software. We have online ordering capabilities through a company like Olo, where we're able to maximize our kitchen space even at times when we're not busy. There's a lot of software that we use that guests don't see. Our accounting software is super advanced in our knowledge of every cost center, as well as our safety, serving people safely. I often remind our teams that the end result of our work is consumed into other people's bodies. It's really important to make sure that everything's very safe. So we use a lot of technology and software behind the scenes to make sure that we're checking things on a regular basis, monitoring temperatures and equipment, and all the components that go into that.
And are there any pieces or areas of the experience that you guys are intentional about not adding technology today?
Some of the broader ones, a lot of people are pushing about robots to deliver food and drink, and that doesn't fit for us. I think it has its place elsewhere, but we still want to maintain an elegant environment, and that doesn't really fit into it.
Okay, that makes sense. Is there anything that you're looking for from a technology perspective that you haven't been able to fill the need on?
We're always looking to be the organization of how business comes to our restaurant, our kitchen in particular, is really important. And the software, thinking about how online orders and restaurant volume come together, and two being aware of each other so that we can handle the volume. Online ordering is very, very scary for restaurants because you don't know. You don't know at any moment who's about to submit an order for 50 people. So how those come together is software that I think in the future will be really useful for us.
Okay, yeah, hopefully maybe someone in this room will build a need for you. Great, and then for the pieces of technology that you've added at Something Proper that are guest facing, how have you perceived and managed the guest reaction to that new process or product?
Mostly positive. Mostly positive. It's very, very simple. The QR, everyone knows what to do with it, and it really requires limited direction from our staff. It's very, very simple. There are some people that will resist and don't like that. They don't like pulling their phone out maybe during dinner, but for the most part, the reception's been really positive, and we see it through social media comments. When we monitor our social media comments very, very closely, and over the amount of time we've lived with Sunday.com, we have 0 comments out of hundreds and hundreds of comments. We have 0 comments that said anything negative, and that tells us a lot. That silence tells us a lot.
Yeah, that totally makes sense. And you mentioned the volume of data I think that Sunday provides for you for Sunday, and then also for other pieces of technology that you're using. How are you using that data today?
We measure everything, and we use it to drive performance. So in a restaurant group like ours, our goal is to get everyone operating as closely together as possible in everything that we measure. We don't want to have someone so far behind or so far ahead. Sunday helps us in that regard, and other technology pieces, because we're able to measure everything. With Sunday, we get enhanced social media results, which is extremely important for us. Our Sunday relationship has driven our Google score almost a full point in some instances for our restaurants, because it's driving the action, and it keeps us on our toes. I also get very usable data real time that I can turn around back to my team and monitor performance and give feedback and coach. So that speed versus waiting for an end of the week report is critical. It drives everything. It can even impact how we lay out our floor plan and impact the income of the team that we're working with. So Sunday is a game changer in that perspective. Reservation software also, online ordering, all these components, they're revenue centers for us. So the speed of it and the consistency of it is exceptional.
Great to hear. And then when you think about where payments and other parts of the restaurant experience from a technology perspective are going over the next, let's say 1 year, and then let's also say 5 years, where do you see as the future that you would like to see for your restaurants?
It's hard to imagine in the future that everyone will not have digital payment. It's too safe, and you see the trend probably where you are too, that a lot of places are going cashless. We are converting our Tin Lizzy restaurants to cashless. So digital payment, I can't imagine it not being everywhere very soon. The QR code, I imagine that'll probably evolve to something different. Design is very important to us, design and the vibe of our restaurant. And it's hard to fit a QR code in there that makes the designer happy. So I would imagine in the future that would be something that we can't see.
Yeah, that totally makes sense. Well, thank you so much, Jay. I wanted to see if anybody had any questions for us before we close out. Yeah.
One of the challenges I've seen is that there's so many different vendors that you want to download your apps. So that's when you have to download an app. That's the way you do it. And you get it back to how you don't just pay. What are you guys doing for that?
So I can comment on that from the Sunday perspective, and then I'll let you comment as well. That's a really important point, and something that our founders and our development teams have thought a lot about. And for that reason, Sunday is not an app that you download on your phone. It's also the reason that we've very intentionally gone to multiple different POS systems, point of sale systems, and developed integrations with each of them, so that if you're at Del Bar in Inman Park who uses Toast, or you're at Tin Lizzie's who uses NCR Local, or Turtle Mix who use Micros. You have a constant guest experience and a constant payment experience. So the first time that you try it somewhere, you do the exact same thing at each of those other locations without downloading an app or having to put any of your personal information into the experience.
Yeah, completely agree with you, and I would tell you with a high level of confidence, our guests agree with you that's when we bring up technology for a rewards program that we utilize a company called Thanks, they do not want the app, which fortunately they don't have to have the app, but my experience would support what you said.
Yeah, go ahead.
I've had the experience of going to an restaurant and using the app and something and all that, and definitely it's interesting. It helps with the efficiency of the whole experience. I do miss some of the personal touch of a good waiter or waitress telling you about what's good today, what's fresh today, what the specials are, and essentially kind of having that connection. When I go, I'm a foodie. When I go to a restaurant, I enjoy the entire experience, and that's one component of it. Have you guys gotten any feedback about that and how technology can solve for this side of it?
Yeah, you're right. When we went through the world changing with COVID, our industry was deeply impacted, and a lot of people left our industry. So as we recovered and went through staffing challenges, we were rebuilding restaurants without tenured leaders. So I think there's a renaissance coming in service. Because we've leaned so heavily on technology, I see the other side is coming up. We're starting to gain on momentum. Technology helps us. The training platforms that we use are fantastic. And we can put it directly on a team member's device. So our acceleration of knowledge is catching up, but not leaning on the software is the responsibility of the restaurant operators. It's to your point exactly, so you have human, knowledgeable people offering hospitality and knowledge.
And I would say from the Sunday perspective, when the product was created in the Big Mama restaurants, it was very intentional that the core product, the pay at table solution, does not have to include ordering via QR code. It can just solve for that 15-minute period of time where you're waiting for the bill versus replacing a server completely. So it's a dynamic solution, but the solution that Southern Proper is using does not include ordering through the QR code. It just solves that efficiency gap. Yeah.
Graylin, for your success with Sunday, do you feel like it's been primarily focused on major cities, or that you're starting to see more adoption in rural areas as well?
That's a great question. I would say that until about 6 months ago, it was really focused on the major cities, and because, especially in the Southeast, we've seen our reach grow in Atlanta specifically, and seen the byproducts of people that are coming from outside of Atlanta and trying Sunday and then going back to their home restaurants. We're starting to see that expand out really organically, which is great to see because it means that the guest is craving this type of seamlessness in their payment experience. Thank you. Yeah.
Thank you for the time this afternoon. Really appreciate it. Jay, I want to pick up on something you mentioned about digital payments at the end, and that feeling that I can't imagine it not being everywhere. I do a lot of work on the consumer end of the spectrum, so that's with credit card issuers, that's with wallet providers, that's with the payment rails themselves. If you had their ear for just a minute, a question or two, why haven't you? What would you be asking, and actually Caroline you as well, what would you be asking them to do on the consumer side, on the payment instrument side of the spectrum that would change the game?
I want everyone to leave a review. I want every single transaction to have a review attached to it, and I want to access it quickly because I can tie that back and I can drive service with that. And I think it could be a really quick and easy thing. Sunday does that for us, and they make it very simple for our guests. Other than that, I don't know that I could come up with that.
That's a great question. I think that my main answer would be around the legislation around Apple Pay being treated as a card not present transaction. I think it would revolutionize the industry and margins for restaurant operators if it was treated as a card present transaction. And I know that there's a lot of movement in that area right now, so hopeful that it moves, it continues to move, I'll say. Yeah.
Have you guys heard anything about the Service Industry Tipping Compliance Act that is initiated from point of sale, having to report tips for service providers?
I am not familiar with that, are you, Jay?
I'm not well versed on that today, no.
So there's an act called the Service Industry Tipping Compliance Act that the IRS is floating that will require, due to advancements in point of sale systems, for you to report those tips that individuals in the service industry make in a more detailed way. And so just kind of interesting to see how those kind of things, especially IRS regulations, changes the restaurant, staffing and hospitality kind of mechanics that exist within the current system. And I think there's a lot of tipping fatigue right now within society. And so just interested to hear if you guys ever come across any of those kind of regulatory shifts that may cause you to change the way your restaurant groups and your software providers operate.
I don't know. I know that when we just, I guess anecdotally or an aside view of that, our tips have increased significantly since we started using Sunday.com. On average, anywhere from 3 to 5% per team member they're making a higher income. So that has been incredible to see. So and it's been a staffing advantage for us where we've been able to maintain our staff. They don't want to go because they're making more money.
And I think the concern with that Service Industry Tipping Compliance Act is that it will drive a lot of tax revenue to the federal government and the state government, which also then is not tax revenue that's currently being reported on a consistent basis, at least all the way up to minimum wage, and then nothing else is really reported. Just interesting.
I think that we're out of time, and it looks like all the questions have been answered. So thank you guys so much for joining us today. Jay, thank you for joining me. Have a good rest of your day.
So, in our last conversation, for those who were in the room, we were talking about how seamless payments are an important part of the customer service process. Now we're going to change the script a little bit and talk about AI. What does AI, how does AI work at the intersection, and how is it impacting the future of fintechs? The person who we want to talk to today about this is, of course, Sebastian Builes, who is the CEO and co-founder of Arcum. If you were here last year, you'll be very familiar with what Arcum is building. But I think this is an important conversation to have because you know what? AI is the central story of 2023, but it's not just the big players. It's not just the ChatGPTs and Googles that are creating the new and the next in terms of AI. And so we're excited to talk to a homegrown startup here to tell us a little bit more about what they're building and what the future of commerce looks like as you help merchants. So Sebastian, I'll let you take it away.
Thank you, Maija. Full circle moment here, actually. When we first got started, nobody had ever heard of us because we're a little tiny startup out of Atlanta. And here Maija was reporting about us, and funny enough, that's how we connected initially with Global Payments, who you may not know. That article kind of sparked that conversation. But as Maija mentioned, I'm the CEO and founder of Arcum. We specialize in helping payments companies reduce customer churn. We'll talk a little bit about that, but I've been working to help companies reduce customer churn, subscriber churn, merchant churn, ever since I finished grad school. And that was about 7-8 years ago, not last year. But the idea, fundamental idea, as we worked to solve this problem was twofold. The first was the realization that the way customer success or customer retention or the interaction post the sale is fundamental, and it's usually not followed by a straightforward process as it is the sales process, nor do you have the tools available like the CRM that sales leaders rely on to do a good job. So during my time, I realized that for the most part, customer unhappiness was something that we cared to solve after that customer had decided to leave. Now let's be honest, and here we're in a room of big companies, small companies, technologically driven companies, and well, it doesn't matter who your product serves, or how great your product is, or how good your team is. At the end of the day, at some point, you will have a bad experience with one of your customers. That is not a matter of if, but when. So my question to you is, as these bad experiences occur, although we may not be in control of what happens with that particular issue, we have full control in determining or taking actions after that bad experience has taken place. In other words, do we want to contact and throw the kitchen sink at a customer who's calling angry, or do we want to flip the script and call that customer before he calls us, proactively engaging that customer before that decision to leave has been made? So it's, according to PwC, 1 out of 3 customers are willing to abandon a brand that they love. And here in payments, I'm not sure what payments company is loved by many, but the idea is still the same. What are we doing to ensure that our customers, when they experience an issue, we're there proactively engaging them in solving these particular issues? Now, modern day retention strategies, I love them, because I was actually a LA Fitness member, and when it came time to me leave LA Fitness, it became nearly impossible to leave, right? So you probably experienced this, like, oh yeah, no problem, just go to our website, print this form out, and then mail it to a P.O. box in California. Oh, you can't do that? No problem. Just come between the hours of 9 to 5 and speak to one of our reps, and then he'll print out the paper for you. Again, this is an actual retention strategy. To make it extremely difficult for your customers to leave is an actual thing that companies do. Now, I'll ask, will you ever return to LA Fitness after that exchange? Chances are not, right? Which leads me to the other end of the spectrum, something like companies like LinkedIn do. I used their sales navigator for a month. I realized that I wasn't really getting the value to stick on it. So when I'm ready to cancel, I get an offer for a 50% discount on my LinkedIn Premium. I don't want it right then and there. I had made the decision to churn. But what if LinkedIn had looked at my usage history and realized this guy was using our platform for the first 2 weeks, second, third week, starts dropping off. By 4th week, he's no longer sending email messages. Well, it might be time for me to proactively engage this customer. And that is what I'm talking about. It is not waiting for the customer to call you because you have an outage and he's trying to figure out how he's going to get his money. Instead, is you proactively engaging that customer and saying, hey, we understand you have an issue and we have a solution for you. So what if payments companies, banks, financial service institutions had the ability to know exactly what customers were likely to leave and why? It will solve a lot of problems in terms of understanding or spending the most efficient time only contacting customers that need to hear from us. This creates an entire new way of managing customer success, where we're no longer focusing on reaching out to every customer that we have, but instead, it's a matter of starting a dialogue with those that are extremely unhappy and need our attention the most. Now, I've been doing this for the better part of my professional career, but for the past 3 years, we've been helping merchant acquirers in the payment space reduce customer churn. But I don't think that this solution is only available or should be available for merchant acquirers. In fact, it's a very straightforward system that we have built, and I'm hoping to share today to enlighten you, whether you're in insurance, whether you're in banking, or whether you're in a consumer product-facing company. It does not matter. The future of retention relies on us leveraging data, packaging those insights in a way where our customer success team or retention manager or the person in charge of managing that account has access to at the right time, at the right moment. So it begins with getting our house in order. What does that mean? You'll be surprised at how many large companies do not have a single source of truth within their data sets. Some of it is in one system, another one is in another system, and none of them talk to each other, and God forbid that we have to aggregate all this information and create real valuable insights that actually drive them into our business, right? So getting that data in order from day one, it's necessary to do any types of analytics, let alone create predictive models to help you reduce customer churn. In our case, what do? We leverage 4 main data sources. The first data source is transactional information. This is information about the merchant, who processed, how much volume have they processed, number of transactions, etc. We also look at service information or service tickets. In other words, how many times are you calling on a monthly basis, and is this changing historically, right? We also use product information. What product are you using? What POS is the merchant on? How many terminals does he have? Last but not least, we'll add economic information or economic inputs. And this allows us to determine if the drivers of churn that we're seeing are internally driven, like pricing, service, maybe a terrible customer rep, or something more along the lines of a microeconomic issue where only one specific vertical may be facing. Or maybe it's something along the lines of a macro issue, where we see the inverted yield curve flip, and all of a sudden everyone across the US is looking for funds. Well, as payments companies, you have levers or tools to help these particular businesses or merchants navigate through these tough times, and therefore strengthen that customer relationship by proactively not only engaging that customer, but solving their pain points without having them call you. The second important thing to do is, yes, getting the data is important. Building the fancy churn models is important. But insights without a way to take action, it is nothing more but a pretty report. So it is fundamental that as we derive these insights, it becomes empirical for us to package those insights in a way where a customer success individual can drive value out of this particular exchange. So without insights, customer success manager does not know who to contact. But having them at the right time, at the right place, when that customer success manager needs it, is the future of commerce. The last portion of it is, okay, now we know who's going to churn, we know why there's going to churn, we even know what should be done to prevent this account from churning. Now it's all about personalizing that outreach. What does that personalization mean? That means that depending on the issue or problem your customer may be facing, your response to him will be something along the lines of solving their pain points or issues. In our case, we flagged an account a couple of months back. Given that it was a smaller sales volume, we decided it was important for them to simply give them a call. What we learned is that the customer success manager did not call the merchant. Instead, they decided to email that account. What they learned was, as the account responded, said, well, someone should probably give me a call because there's some money in my last couple of transactions that never hit my bank account. Right? This is what I mean about proactive personalization when it comes to customer retention. Right? It is not a one-size-fits-all approach for every single individual, but instead it is a custom tailored solution to solve specific pain points that each individual of our clients may be facing. Now, what are some examples of a personalized outreach? Well, in the case where there may be a service breakdown or an issue with service, well, maybe providing a call or a simple email to this particular account to let them know that, hey, we dropped the ball. Acknowledging that problems occur, yet this will be the last time that this occurs, or at the very least that you work hard to ensure this never happens again. But when soft touches like an email or phone call are not enough, maybe taking it a step further, or what I call, or what our best customers use, essentially cross-selling customers at risk of leaving with solutions to their problems. For example, the customer, in our case, the merchant is experiencing a pricing issue. Well, two things can happen. You can lower their price, or you can offer them a new product or solution that decreases that merchant's burden for credit card processing. In this case, a cash discount program. And the last thing that I'll talk about is, what if it's an economic shock? Well, in that case, as a payments companies, we have access to merchant cash advance, have loan options, right? But the idea is to, no matter what the problem of your customer may be, leveraging data to identify their pain points will enable you to proactively engage that customer and come to the table with a solution to their pain points. I'll leave it with this stat where if you think this is nice, sounds nice, but it'll probably, it's very hard to tackle or actually execute. We've seen that every account we flag is 4.5 times more likely to churn than any other account. And in fact, our customers so far are seeing reductions in churn of at least 10% in the first 6 months. So this is not a theoretical talk. This is here and now. This is how companies are leveraging data to proactively engage their customers and reduce churn. Any questions? Thank you very much. Oh, Brad.
So, you're starting with the fintech industry. You see this expanding, the capabilities expanding to other industries out there?
I fundamentally believe this is the future of customer relationship management. It's not about when was the last time that you and I spoke with a client. Instead, it's a function of the probability of that account leaving. Right? In other words, why waste my minimum resources contacting an account that does not want to belong to me? Instead, of focusing those resources on that 25% of accounts that are highly dissatisfied and discontent with our current product offering or service.
Question. Remember you teaching me last year here, and you were basically talking about you already had a company that didn't have that many numbers to tell about their actual customers and the actual impact that they generate. So how would you assess your evolution this year, and how much more mature your company is today that you can actually tackle?
Last year it was slides, screenshots that we created from our Figma files. A lot of this we're doing in Excel sheets. And what we learned is that it's very difficult when you have multiple customer success or retention managers to execute on a strategy that actually reduces churn. There's not complete visibility and collaboration amongst your different team members in charge of reducing that customer churn. So as we actually build the product around our solution, we learned that we're not going to be charging for seats in here, because I am highly incentivized for you to lower your churn rate, because that's how you tell your friends that our solution is the best. And in order to do so, you need to get access to as many customer success individuals in your team to ensure that they have the right tools at the right place at the right time to do their job. terms of where do we taking it? Well, I think that we're only scratching the surface. And the same data set we saw in China, there's a number of problems that we can solve by leveraging this information. Thank you.
Thank you.
All right, we're going to get started here in one moment. I appreciate you all for joining us here in the Future of Commerce room. If you haven't been here all day, we've been talking about AI, the impact of AI on the customer service journey along the way. And now we're going to switch gears a little bit and talk about super apps, something that I think we're just starting to get into the kind of zeitgeist, at least here. And so appreciate you all joining us today. Again, my name is Maija Ehlinger. I'm editor-in-chief of Hypepotamus here in Atlanta. And I'm honored to be joined on stage here with Will Graylin, who's the founder and CEO and chairman of OV Loop. I think the best way to kick this off, we've got a list of questions here, but I think the best is, Will, if you could just give us a brief introduction to yourself and your elevator pitch of what OV Loop is.
Sure. Pleasure to be here. Thanks for having me. And, I think many of you guys have heard of super apps, maybe in the context of WeChat Pay over in China, or Paytm in India. And I was, in fact, just in China a few weeks ago, and that super app has not only prolifically grown, but it has become the fabric of everyday life over there. I was trying to pay with my cash as a foreigner, and people were literally looking at me funny, like, what? You expect me to give you change? Where are you from? And when you look at what happened over there in China, that's a different ecosystem. It doesn't necessarily translate. You can't just resurf that wave here. I call that the Galapagos Island effect. And what plants and animals flourish over there, there's a different ecosystem over here. In fact, we're going to talk a little bit about that ecosystem. I kind of grown into that ecosystem, a little background on myself. I came to this country when I was 12 from mainland China, and went through undergrad as an engineer, and became a nuclear submarine officer, then served 6 years in the Pacific, then went to MIT for graduate school. And that was when I caught the entrepreneurial bug and started my first security software company out of MIT. And then after that company was acquired after September 11th, I thought, how hard could it be to build a mobile wallet? Well, remember, these were black and white phones, and we were still on WAP. And as it turns out, we had a very cool technology that allowed us to get past the mobile operator walled garden with a virtual SIM, but we couldn't solve the chicken and the egg problem. So I very quickly realized that to create a mobile wallet was much more difficult because you have to have enough merchants for the consumers to care and enough consumers for the merchants to care. So we pivoted to turn that into a mobile point of sale. And that was the first pocket-sized point of sale that was acquired by Verifone. Then smartphones came along, and we had a little plug-in dongle to go into the smartphones, and we became the largest supplier for everybody competing against Square. And that company was acquired by Ingenico. So 10 years of point of sale and understanding how the payment network operated. Then I went back to mobile wallets. And that was us inventing a technology that worked with magnetic secure transmission to send tokens on contactless payments on existing point of sale. So Samsung ended up acquiring us, and I became the global co-GM of Samsung Pay. Now, having seen that journey of point of sale, merchant acquirer, merchants, and then consumers, and mobile devices and mobile wallets, what I've learned is that the United States is set in a very fragmented environment. And as we approach the digital, I call it still the digital Wild West. And if you want to set up this new infrastructure and this new solution, you really have to re-architect it. there's an old saying that the further back you look and the more historical context you have, the further ahead you're likely to see. So if I was to look at how the super app is going to evolve here in the United States, you have to look at it in a different context, because today what's happening is we have fragmented point of sale, fragmented applications. If I go to Starbucks, I need to download the Starbucks app. I go across the street to Dunkin' Donuts, I got to download the Dunkin' Donuts app. And the small coffee shop, forget it. They're not even going to have their own apps. And every retailer cares about their own standalone real estate and their standalone app, just like they care about their standalone stores. So how do you deal with all of this fragmentation? And it reminds me of when you think about how the world evolved. We started out from the Wild West, where to even set up a town in the Wild West was hard. We needed to have people were pitching tents, right? Then the infrastructure started to be built for buildings and retail stores, and you need law and order to protect your property rights, and eventually you get your own property rights. But to migrate from the east to the west, you needed to build the transcontinental railroads. Otherwise, it's too hard to go through the Donner Pass to get to California. So that infrastructure needed to be set up. Well, towns got set up, cities got set up, but then the migration to suburbs happened after World War II. The economy was expanded. So how did retail set up? Well, they set up in standalone stores across town, and it's their job to drive you back into the parking lots, right? And all of that continued to take place, this fragmented storefronts, until 1954. There's a crazy guy named Victor Gruen that says, he was an immigrant from Vienna, an architect, and he says, I want to architect this mall where all of these different stores, large and small, and services and community come all together under one roof. And everybody thought, you're nuts, that's crazy. But as soon as that first mall actually got built, the penny dropped, and everybody go, oh my God, it's about the community. We get more foot traffic because of community. Consumers are happier because of the community, and it's more convenient for them. So that Victor Gruen moment took place. And by 1960, there were 4,000 malls. By the mid-'80s, there were 30,000 malls, representing more than 50% of all commerce. So that community needs to take place, but it required a new level of architecting. And that's what's missing today in the United States, because you have people that actually wants to keep it status quo. They don't want to have a wallet that works across iOS and Android and cut across and allow merchants to have a direct interaction with the consumers. And so if you want to build this new digital wall and this new digital wallet where you have the rights and I have the rights to my own keys, to my own digital vault, whereas today, I mean, think about it, we have an app for everything, right? The one app that we don't have is our private universal digital wallet that we own the keys to, we own the data to, and that it works across iOS, Android, and across these different merchants. So how do you architect something that is unifying commerce, that brings brands together under one community, one roof, and that allows consumers to own their own data so that they can have not only their digital data and content, but also their private digital curated mall effectively becomes a large merchant city. That's what Elavon is all about, and we've been building this for the last 5 years. It's a hard undertaking, but we're finally at the point where we are now commercially available for download. We're in beta with multiple merchants, and we're right in the middle of convincing and bringing on some of the largest retailers to become anchor tenants, because it's in their interest and their customers' interest.
Before we dive into the architecture of how you are making this digital city possible, I want to make sure that I understand, or I want to understand why you think the U.S. is ready for this type of thing, ready for a digital city that you kind of described, and how do you know we're ready to move past this digital Wild West that you're talking about?
So I would say nobody's ready for the future until the future is built and ready for you. So Victor Gruen saw decades before the mall concept of these individual stores being set up, and it was unimaginable for Macy's and JCPenney's to be set up. So were they ready at that time? Well, what needed to happen was someone brave enough to invest in Victor Gruen's idea. And for that first mall to actually come up with some anchor tenants, Builes, these are names that you may not hear, but to bring that community together, to fulfill that vision. So we're definitely ready. I mean, the frustrations, when you look at retailers and you look at brands today, retailers are frustrated not only by the hill that they have to roll this rock up over and over again by paying advertisement, by spamming their customers, by doing whatever is necessary to get their attention, while we are sick and tired of spam every day that we got to clear out on our email, non-stop advertisement that pops up, and app after app, if we want that reward system, inability to contact our customer service for solving problems. These are all because of lack of intimacy and lack of a super app that is in between. So are we ready? Of course we're ready. Just who's got the solution?
Okay, well, you have the solution. I want to talk about the technology that OV Loop has from two perspectives. One, from the merchant's perspective, and then talk about the consumer. You talked about the pain points that all of us as consumers have whenever we're talking to people in our daily, whether it's buying a coffee or whatnot, the friction that's there. Let's start with the merchants. How do merchants work with OV Loop, and what solutions do you bring to them?
So what we bring is that infrastructure that we've spent the last 5 years building, so that we can go to a merchant, large or small. Now, of course, the larger ones, they want to spend the time to build it right. But a small merchant can literally sign up in 25 minutes and be part of the mall. So it's almost like here's your storefront, here's the electricity, here is the door locks, and here are the shelves. And you can populate literally in 25 minutes. You determine how much reward you want to give. You don't have to change your POS system. We take your existing website URL and portal, and we plug directly into the digital wallet. And then now you can invite your customers to join your loop and offer your rewards, your coupons, your gift cards, and your direct interactive offers.
And then walk me through as a consumer. If I'm walking into a store that works with OV Loop, what does that consumer experience look like?
So for consumer, most likely that they'll experience OV Loop for the first time, seeing that there is a 5% cash back, 10% cash back, and join my VIP loop and get special offers, etc., etc. So it's usually probably you've experienced it, seeing that the merchant has an offer for you. Now, over time, you may be, for example, working with a university. It's not just retail. We're working with universities where you can have peer-to-peer payments. You can have all of these stores giving you X percentage off, so you don't have to carry around those old entertainment books that I used to carry around when I was in college. And so one application is your universal wallet app, and this is why you should download it. So you're probably seeing some kind of an offer and discount. Now the great thing is this has a snowball effect in that when you only see it with one merchant, you may not right away download, or you might, because you want to save money. But when you start seeing it more and more, the more merchants, more brands that are part of this digital community, the more likely the citizens are willing to come. So, and that's the same thing of any migration to any physical city. You need to see that there's activity, and the more activity, the more likely to say, hey, that smells like opportunity. I'm willing to download the app. I'm willing to migrate.
And then, from a business model perspective, how is OviLoop making money throughout this transaction process?
So what we do is we actually offer a lower cost transaction for the merchant, and the merchant can offer their own private rewards cash, their own time-based coupon cash, and they pay on a per drink basis. So if the more they're promoting it, they get the added benefit of, if they're the first to introduce their customers into the mall, they earn the real estate fee at the front of the mall. So, so you get what you put into it. If you don't advertise, if you don't promote, or if you come later, you're at the back of the mall, because other people will discover how to join OviLoop. But if you're the first merchant to introduce them, you're pinned top of the wall or the front of the mall. So that's the incentive we offer to the brand, and we get a piece of the transaction if we're processing rewards for you, and then there's a fixed $49 a month fee for you joining the loop. It's almost like being listed on the yellow pages, if you still remember yellow pages.
And you mentioned it earlier, but this idea of, how do you create that snowball effect and that network effect? Talk to me about how you're going out and finding merchants that might be ready for this type of experience.
So what we're doing right now is, of course, it was pretty easy for us to go and sign up some smaller merchants, because this is low barrier to entry, no change to the POS, easy to sign up. But at the same time, they're small, so their influence is limited. We are right now talking to some of the largest retailers, and for the largest retailers, they are very concerned about where the world is going. They're losing their edge, where the physical world, as long as they have the right real estate, they had a good business. But now the digital world, people like Amazon are taking business away from them. And when people come into the physical store, they don't know who's walked in and who's walked out, and very often they don't have a follow-up, they don't have an intimate relationship. So by offering them the ability to have a digital relationship with at the most intimate real estate that you can possibly get, which is your private self-custody digital wallet. When I say self-custody, I mean you derive your own key. We cannot get access to secret data. We're not going to monetize your data. So if that becomes your private wallet, where not only do you put your bank account, your credit card, you put your ID, your membership, your passwords, your crypto keys, NFTs, whatever you want to put in there is your data, and it doesn't matter whether you're iOS, Android, PC, Mac, you can have access to your data. That is the most intimate real estate, I would call it. Would I want to be there? I be there early. And if we offer that level of promise, we're going to need some brave and visionary retailers and brands to join us first. Just like I can tell you right now, people looked at Victor Bruin like he was nuts, because to share real estate with your competitors under the same roof is unimaginable back then. And it's still unimaginable today to say, hey, we're going to be, playing in our customers' sandbox together. But as soon as that first brave anchor tenant starts to go, it gets a snowball effect, it becomes unstoppable. That's why I say, within 6 years of that first mall, there's 4,000 malls. So that's the snowball effect that we need.
You brought up a good point about security, the aspect of, we're giving so much data of ourselves, but putting it into a responsible way is, it sounds like it's at the center of what you're thinking and what you're building, which is great. We have a bit of time. We've got time for maybe 1 or 2 questions. If there is any, yes, in the back.
Hi. I'm still puzzled about the comparison with the physical world and why a Starbucks or McDonald's would want to put you between them and their customer. Right now, I can have all these apps on my own personalized mall. It's called my smartphone. It's very different than out in the physical world where there was a ton of friction. I had to drive to the other store. There was cost, time, etc. I can switch from Starbucks to McDonald's to Macy's on my phone right now. So what's the motivation? Because they want to have that direct relationship with me as the consumer and not necessarily have somebody else who's getting in between them.
Yep, it's a great question, and that is the state of today's art, which is I build an application, it's mine and mine only. So therefore, I'm also absolutely responsible for cost of acquisition. And I spend a lot of money, if I'm Starbucks, to acquire my own customers. And then what do I need to do? I need you to actually invest in putting your data. Get your payment card stored in my digital database. Go to the trouble of even transferring money to load some Starbucks money. But that's hard to replicate. And what happens is just like the old physical storefront. People spent all that money to build their own storefront, but there's no community network effect. And when you don't have a community network effect, then you're not part of this digital community. You're really part of on your own. So large retailers, what's in it for them? So why would I want to be part of a strip mall? Why would I be part of a physical mall? Well, we believe that the community network effect in a digital environment is actually more cost effective to see that foot traffic. And this is not just any app. This is not us that they're trying to say, you're in between me and my customers. We're actually facilitating the infrastructure. We're the mall. We're basically saying, you get a chance to be your customers' super app, your customer's private digital wallet. And that should be the most valuable real estate that you should invest in. But doesn't mean that you're going to have to get rid of your existing app or your existing website or your existing physical store, because those are real estate that you already own. So keep owning those. It's just that there is new real estate and there's new communities, and you want to be in that community. Even Walmart wants to be in that next town that is growing, even if they just want to be the center of that town. Right?
Well, we could talk about the future of the digital city for the rest of the afternoon, but we have to stop here. Appreciate a round of applause for Will. Thank you so much for everybody for joining us today. All right, thank you all for staying around for this last conversation. I realize this is our last conversation here in the Future of Commerce before, I believe there's some drinks involved after this, so appreciate, we know we're the only thing standing between you and a good happy hour. So again, my name is Maija Ehlinger, editor of Hypepotamus here in Atlanta, and welcome to the Future of Commerce. Today in this room we've been talking about the impact of AI, where super apps are coming in and what their impact of commerce will be. And now we're going to shift gears a little bit and talk about real-time payments and buy now, pay later. For those in the payment space, you know that the buy now, pay later industry has gone through its ups and downs over the last couple of years, but we're excited to have on stage some experts and some industry leaders who can walk us through what's happening now. To moderate the panel, it's great that we can bring back Melissa Schmidt, who's SVP of Elavon, who is also sponsoring this event, this group here. Then we have over here on the left side, Barclay Keith, who is CEO and co-founder of Momnt. And then ignoring, we have a special guest pinch hitting here, which is Colin Mellon with Splitit. With that, I'm going to hand it over to Melissa.
Thank you.
All right.
Yeah, one of those pictures doesn't look quite right. Nandan does apologize. He wishes he could be here. I'm going to record that. Pinch hitting in his spot.
Exactly. Jack of all trades, so you're the pinch hitter. So thank you very much for sticking around throughout the track. I'm sure it's been really good. And yeah, I guess the only thing standing between you and Barclay is the conversation of commerce and customer experience and merchant experience are related to buy now, pay later and real-time payments. So to start off, again, thank you, welcome. It's the end of a very long day, but hopefully this is going to be worth your time. Again, my name is Melissa Schmidt. I'm head of sales and marketing for Elavon and U.S. Bank's POS lending team, and I'm happy to be here, and I'm happy to be sharing a conversation with Barclay and Colin, and I'm going to I'll hand it over, and let's do some introductions.
I'm Colin Mellon. I'm the Chief Commercial Officer of Splitit. Splitit is a card-attached installment platform whereby we provide what is traditional BNPL, but we do it through a very different way. We allow the consumer to use their existing cards, and then we provide them a zero fee, zero interest installment solution based on their open to buy, available to buy a portion of their credit cards.
Yeah, I'm Barclay Keith, CEO, one of the co-founders of Momnt, located here in Atlanta. We are a platform for embedding real-time financial services natively for enterprises. Think real-time payments, real-time loans, long-term, real-time insurance products, they're all native in that infrastructure created by that enterprise, and they can really leverage them for that consumer's experience, whatever it might be.
So we're going to take a journey, if you will, and we're going to start with a history lesson. For me, we're going to head into more of this embedded finance, really where the future of commerce is embedded finance. And to me, BNPL is not a product, but a lot of people have very visionary, like they think it's a product in and of itself, like a paying for a product, but it really is that act of a lending solution at the point of sale, right? The decision that a consumer makes, whether they go forward with a purchase, what can they do? So it's a much wider breadth of a conversation that we'll have. So to start this off, we're going to start with a little bit of a history lesson. So Barclay, this is going to go to you. So much has happened over the last 50 years, right? To get us to the point where embedded financing is expected in a customer experience situation. So can you kind of give us your take on what has happened over the last 5 decades?
Yeah, thank you for the 3-hour time slot this morning or this afternoon, or whenever time of day you're in. When you look at how we got to embedded finance, it's a compilation of other technologies that are really built in here. And we can kind of classify this in the last 50 years because the 200 years before that, it was very, piecemeal, incremental technology that was all infrastructure, right? Think connecting payments, think Swift, think systems like that created the basis for what we're now innovating on. Really, we started to see the tide turn in late 2000s or early 2000s, late 90s when PayPal was the first real tech company to come in and challenge the banks with services that were traditionally bank services. That started to accelerate through the early 2000s until the great financial crisis hit. That was the real catalyst for a lot of financial innovation because the banks at that point created this kind of chasm that had to be filled by somebody. And so fintech stepped up and started to say, hey, we can offer these products, a lot of lending products in real time in a way the traditional banks didn't necessarily offer these products. And so 2009 and 2015, lots of fintech startups started to enter the space, and then 2015 was really another massive changing point. I think for us as an industry, that was the first year we saw consumers transact the majority of the time on that mobile device, right? The proliferation of cell phones in all of our hands that are smartphones really enabled that consumer to have all of these services in real time. And they became prone to expecting these services in real time. So again, that same bank that had the interface from the early 2000s in 2015 was outdated. And all these fintechs started grabbing market share and really having an impact. But I think the mindset of these banks was still, hey, they're competing against us. They're not strategic partners yet. They hadn't evolved to that position where I think we're at today. Between 2015 and 2020, really, we saw some other technologies come to play that have made folks like us possible, frankly. You saw cloud computing. You saw real-time alternative data to the point where we could not only make great loans, but we could put a lot of different financial services into place on the fraud side as well that made our tools really powerful but feasible, more importantly. We saw cloud computing and all of these other major pieces come into play that enabled AI and allowed us to make really better decisions across the board. And all that happened in about 5 years. So again, we talked about the last 50 years. Really the last 20, we saw the vast majority of innovation happen due to a few different crises, a few different technologies that came into play. And then again, innovators like ourselves who saw that market opportunity to bring a better consumer experience. And so again, now we're kind of 2020-ish, last 3 to 5 years. We've seen that focus move away from, again, broad products to focusing on that enterprise experience where they can really render these products into strategic initiatives that allow them to advance whatever it is they're selling, right? You look at a Home Depot, you look at someone huge like that, they have every incentive in the world to own that consumer's experience end to end. And now enterprises are starting to see that strategic value come to play. And so that's where we're at today. Enterprises are starting to embrace these products and understand that yes, we are potentially fintechs, and even if we're not fintechs, we should own that experience. Companies like us give them the tools to do that, to where we wrap all that complexity into a nice little button.
I'm glad you mentioned mobile phones. Just because that was the major shift. I think when it became, when I started with the Elavon, paper processing was still available, and the knuckle buster was still in use. So for us, for me, it was a very slow ride to technology to get from that point to, let alone not even smart terminals, but just the dumb terminals. And then you sit there and when mobile phones came out, the exponential change and shift in that customer experience and what's available. So I'm glad you mentioned that. Colin, do you want to add anything just to kind of illustrate?
You know what? I mean, I think it's just natural. I mean, we've gone from we're a lending society, we're a banking society, and so as we kind of bring those services forward, bringing them to the point of sale is just kind of a natural evolution of what we do as a business. And certainly, it's exciting. We're looking to kind of do it in a very kind of frictionless, personalized, and I would say a very effective way, so that we are driving a greater customer experience, because I think that's really a big part of the benefit of embedded finance is you have to have an exceptional customer experience. The other benefits are great, but it starts with how do we make getting a loan, getting anything else easy. Nobody wants to go through a off-cycle type of situation. Nobody wants to be taken out of the line at a store. Nobody wants to be, come over here and fill out these forms. So, again, it's all about how do we make it, very frictionless, effective, and personalized. So I think that's just the...
You actually stole my second question, too. You already answered it. But I'm going to talk a little bit more about the customer and the benefits of this offering, right? So commerce has two paths. It's the customer and the merchant, and we're going to touch on both of those in this. Like what's good for the goose is good for the gander. But staying on customers a little bit more. Why is this? It's not about buy now, pay later, and the act of real-time lending has been going on. We were talking about it earlier, right? It's layaway. It's just you get the goods right now, and the merchant doesn't have to store in a closet what you just purchased for the next 8 weeks. So, from a consumer perspective and the way we shop, like, why is this such a prevalent way of looking at where you're going to put your purchasing power?
I mean, we're an on-demand society. We want, instant gratification, and, instant gratification regardless of whether, we may or may not have the means at that one particular moment, but we have the ability to pay for it. I mean, I think that's really what we have here. And we're satisfying that need with a very effective way to offer a consumer to manage that payment. So, I think that as we look at empowering the consumer and helping them manage, their financial responsibilities, this is a really very effective way to do that.
Yeah, I agree. I think it's a financial tool, and if you know how to and what's available to you, and if you know how to use it smartly, it's a tool that, why wouldn't you, right? If it's not for paint the picture of who the customer is, because I think it's not for the under credit worthy. It's not for it's just for giving people the flexibility to choose how they want to pay.
Yeah, and I think that there's a whole spectrum of finance that's made for those lower FICO consumers and even higher FICO consumers. So it's like I said, embedded finance is not for any particular demographic or any particular type of buyer. I think it can be utilized by all buyers of all FICO scores, and it just, depending on the particular situation, it appeals to them and can work within whatever they want to do to manage that particular transaction.
Yeah, I'm pretty much to repeat what y'all said, but yeah, it's truly a structural shift, right? It is a change in how that consumer interacts with these financial services, but also their expectations. If your phone lags more than a second or two on a site, you're like, what the hell's wrong with the internet? What's wrong with my phone? What's wrong with the site? You've now come to expect all of these services at the touch of your finger. And now you have a whole generation that's literally been also conditioned to 0% interest rates, where you can offer some of these creative products that frankly are probably not as viable today. But again, all of that innovation, being able to offer those products, have opened up consumers to this new space that is not just banks, right? They're used to being offered non-bank products on the day-to-day. And so again, that conditioning is something that we'll benefit from in the future for sure.
Pivot to the merchant. And Barclay, I want you to talk on the benefits to the merchant and break it down for us between small businesses, small and medium-sized businesses. How do they get into this? Because people are shopping. We're all shopping on their sites as well, but isn't it, it's already prevalent in the enterprise. So how can they compete, and what are there differences in their benefits bringing consumers in?
Yeah, starting with SMBs, it's really kind of a leveling of the playing field. They're used to competing with a lot of enterprises in a lot of places. It allows them access to loans and real-time payment products that they maybe wouldn't have had otherwise. Those tools then enable them to sell more product, to decentivize their sales reps. They can leverage that in different ways that are all strategically important for that SMB. We've seen folks who, again, leveraging finance, pre-post have driven their average ticket size up, 60-70%, because again, they're now enabling these consumers to afford these higher-end life purchases in many cases that they need in a more affordable manner. Again, these are still interest-bearing loans. We can just offer them in a variety of different situations and different formats that allow that consumer to really control their experience, but also get the right product at the right time in that moment of need. Moving on to enterprise really quick. So, you think about the enterprise, one of our investors is Yamaha. Yamaha's amazing vision for embedded finance is, a global system where they can control and incentivize these different regions, but also they can control the financing on the backside, right? They have these big bank relationships. They have all these relationships they want to be able to put into play and leverage. Right now they can't do that. They have disjointed financial services all over the world. Each country has their own footprint. Being able to do that as an enterprise not only allows you to control financial services and, adjust revenue, but also a huge amount of information comes from that, right? The analytics of having a unified resource. A lot of these enterprises are now becoming keen to the value of controlling that data, those data flows, but also being able to respond in real time to that consumer's actions and their preferences. Those are super powerful tools that just simply didn't exist 5 years ago that exist today.
I was just going to add, one of the things about traditional BNPL is that it disintermediated the consumer from the merchant. So a consumer would go into a merchant at the checkout, all of a sudden they're being redirected to a third-party app in this case, and then more than likely that merchant has lost that customer for the rest of the customer lifetime, because they've now gone into the BNPL, they're now into this online shopping mart, they're getting targeted with offers and everything else. They will not go back to that merchant because they've ultimately been disintermediated. So I think to your point, whether it's SMB, commercial mid-market, or enterprise, these merchants have realized that they have got to provide very effective, technologies to enable that purchase in a manner in which the customer wants to purchase, so that they don't lose them to these traditional, off or out of lane financing options that really don't kind of give them the ability to kind of control their own data or the customer experience that customer is going into as they transition into a traditional BNPL.
Yeah, just can't harp heavily enough on that customer experience.
Yeah.
Everything is evolving back to being completely customer centric, right? Enable that enterprise to own the customer experience end to end because they have the incentive to truly make that the best experience possible, right? That's where this is really shifting. That's how we deviate between what we call kind of the 1.0 or 2.0 players and what we consider ourselves today, which is, 2.0, 3.0 players. But owning that customer's experience, being able to customize it to that enterprise is really a massive differentiator today.
I think some of the conversations I've had around that is with large enterprise customers that have a co-brand already, so they're already collecting customers on their own cards, and they get that data. But then if they're partnering with someone like who you were referring to, sort of has their own marketplace, those transactions are gone, that data is gone, that consumer is gone. And so when you can embed the whole thing and say, okay, take your card holder, give them loyalty points, give them all of the benefit to be repeat customers. But now when you have an embedded finance partner, anyone who chooses a lending solution at the point of sale, that's your next customer to upsell to the card and to the loyalty. But you still have all of that data, and it is that data that they don't want to have different partners giving their data off and not collecting it again. So that ability to kind of keep everybody in their ecosystem and control that experience for them is where they're going to decide to go and partner with.
Well, this kind of goes back, and this is lending has been such a big part of merchants' business. I mean, we can kind of go back and think about General Motors. General Motors made more on lending than they did making cars. Okay, so I use that as an example of how they're going to be bringing it in, how they can control the customer experience from end to end, because they use that lending tool to bring the customer back to rebuying the car. It's the same in SMB and commercial and enterprise businesses. If they can control that experience, it gives them that opportunity to not only kind of keep that customer within their ecosystem and kind of keep nurturing them, but also make money and kind of keep upselling them constantly over and over and over. So it's kind of traditional BNPL has really taken that away from SMB, commercial mid-market, and enterprise customers. And what I think we're seeing is they want that back. They want control. They want that relationship with the customer, and then they want the benefits of what that brings.
All right, so we can't have a conversation about embedded finance without talking about regulations. Near and dear to all of us. But seriously, I think it is not a matter of when, not a matter of if, it's a matter of when. And in that case, Barclay, I'm going to ask you to kind of opine first, but this is going to get interesting, because now banks might play a bigger role in BNPL and in financing at that point of sale. What do you think about that? And who's disrupting it in the future?
Yeah, embedded finance is a broad term, obviously, and so keying in on a few specific areas that I think you're already starting to see regulatory work on is, BNPL specifically. Again, loan stacking, a lot of those consumer disincentives have come to where they're now starting to kind of come to the forefront from a regulation standpoint. So I think, for one, we haven't seen a lot of regulation in the last 10 years, right? A lot of the different, 3 or 4 letter words have really not had teeth, and so they have teeth again, right? You're going to start seeing regulation not only for banks, but for fintechs as well, which will be a first. Right now, it's a bunch of gray space. I can tell you we hold ourselves to the same standards banks hold themselves to, because we partner with banks, right? And so the onus is on us to make our level of compliance very high and kind of at that same level with the bank. That being said, I think that's also why it's important to strategically partner with banks, right? We're not going to get caught off guard when we see those regulations come down, because again, we're already at that standard, even though that standard doesn't necessarily apply to fintechs. Over the last 5 years, really, we've seen a lot of fintechs run, pretty fast and loose. That's all coming to a head. We've already seen that on the investment side. We've seen that, in a couple of different places. The regulators have also seen that, right? They've also seen consumers get hit in certain states. They've seen pieces like that come into play, where this is all about to come to a head, where I think over the next 5 years especially, you're going to see a lot of regulation, not only for the banks, which they've already made very clear, but for fintechs like ourselves, right? So I think the onus is on us to get ahead of it for sure.
I hand it over to you. I feel like they kind of, the Fed and the CFPB, they kind of got goosed a little bit. They set the bar right here, so the fintechs went right here.
Yeah.
It's like, okay, if a loan that is repaid in less than 3 months, is it called a loan? All right, well, then we'll have a 6-week, not call it a loan, but it'll be a 6-week repayment plan. And just that, they just found a way to get in.
Right, and obviously, look, it's coming down all over. I mean, regulation, especially the Consumer Financial Protection Boards, in the States as well as the United States and the EU, I mean, they are really going to be cracking down on this, especially on BNPLs, because BNPL have had kind of a wide open range. And when you talk to a 22-year-old who's got 3 or 4 BNPL, kind of lines of credit and that nobody knows about, it can be a little predatory. And so they're finally kind of swooping in to kind of help that situation. So I think that we're all going to be kind of caught up. Fintech providers like ourselves are all caught up in that. But I think that's to the betterment of the ecosystem that serve the consumer.
It goes back to those, having the availability and the flexibility to choose the way you want to pay is not a bad thing if you use it wisely and you understand. So there's a lot of financial education that I think those of us that are going to play in the space correctly and with healthy financial habits, we need to do our part in educating.
I think you nailed something that's really important, which is the regulators don't understand a lot of things we're doing. And I'm going to key in on alternative data in the credit space specifically. There are a wide variety of factors out there that we would never touch that can make really good decisions because there's not clarity. Again, it's enough gray space that the banks aren't comfortable with it, so we're not comfortable with it. That being said, I know we can make better decisions using AI and ML-based models, but we don't do that today because of the gray space. Now, when we kind of pull back to that 1,000-foot view internationally, I think that puts us at a disadvantage, frankly. I think until the regulators have that knowledge to where they can gap that and understand the implications of using alternative data and credit decisioning and different types of models, I think we're going to be at a disadvantage to where, again, somebody's going to have to eat that someplace on the risk side, and there's going to be some friction that comes from not being able to leverage these alternative data sources to their full efficiency.
All right, Carl, we hand this over to you. We talked about the regulators. What about the card issuers and the card networks? They're not going to be left out of this situation.
No. I think the sleeping giant is about to awaken. The issuers and networks are really, they're going to play a key role in all of this. Obviously they've got the rails as well as the ability to provide the credit that's being provided in other places. So I think what you're going to see is especially issuers are going to want to take a much more active involvement in these opportunities. So I think that they come in, they see that they've got consumers, they've got card programs that can be expanded, they've got loan portfolios that can be expanded. All of this just makes what they're doing that much more effective because they can kind of manage and help a consumer provide as much opportunity out there with their own personalized, management of their spending as they can. So this is a great opportunity for issues, networks, acquirers are going to be coming along to it to really drive value-added services for embedded finance, anywhere and everywhere they can. So, I guess my point is that they're finally waking up to see that they can't let all of this commerce just go out the door, and they're going to make a play to pull it back.
Sounds like we all want to keep the ecosystem. How many times can the ecosystem be kept? If it's, I'm the acquirer and I want all of your business, you're the enterprise customer, you want to keep all of that business to yourself, but I think it makes sense.
Yeah, and efficiencies on scale. Once you can kind of scale these types of programs, it becomes cheaper and better and more effective for the consumer. So that helps the system.
I think everyone's realizing we need each other, right? Like originally banks and fintechs, fintechs are going to be banks, it's going to be like the fintech world. No, it's not. Like you need banks, right? The reality is someone's got to deal with regulation. Fintechs clearly aren't. And again, back to that merchant. They need fintechs as well, but we also need that merchant. We're nothing without a merchant. The reality is all of those pieces have to play kind of nice for this to really work.
We're going to maybe pause for questions, but before we do that, you've mentioned already from the ecosystem needs and the data collection, but between the vast products that are out there, whether it's 0%, whether it's APRs up to 24, 99, 25%, what does a merchant need to consider when you're looking at all of the options that are available now, right? There's partners that can click in really easily, but you might lose your customer to the marketplace, but you're gaining the offer up front. There's so many times I think merchants are like, well, 0%, everybody wants 0% APR. Not necessarily. You don't have to. If you're taking a look at that higher FICO score, maybe they're like, hey, you know what, taking an 8% loan is a lot cheaper than putting it on my credit card and not, and we're letting that roll. So it's just, what does the merchant really need to think about?
Yeah, so we really target someone who's already on a 1.0 or 2.0 product. The reasoning for that is, for one, they've already integrated these products into their sales cycle in some way, shape, or form. They just don't have it integrated into their CRM or whatever they're owning on the back end. They're probably not owning consumer data. And so for us, it's come in, we can integrate this seamlessly in whatever you're using via API, but then you also own that consumer, you own that consumer's experience and all those other pieces. So we're not necessarily trying to cut fresh grass here. We're looking for folks who have already been using something in the 1.0 version. When we are selling a new enterprise customer especially, we generally target someone who already has strategic initiatives around owning one of these financial services because they see the value of this, right? If they haven't already clicked into a mode where they understand owning this solution is going to add strategic value, you're not going to get them there, right? So it's not already on their strategic plan. Frankly, we're not going to be the ones to force them to add a strategic plan. And our product is not good enough to where they're going to change their strategic plans. That being said, we're seeing a lot of enterprises who now have these financial services on their strategic roadmap. And so we can accelerate that, we can make it easy, and again, we boil all that complexity down to a button.
For the merchant, I think the key thing is understanding your own customer. Understanding the value that you're providing, and then your customer, and how you can provide a embedded finance solution that appeals to that customer, that can drive growth, revenue, and kind of scale your business. So it's not just a zero APR. It's not a BNPL. It's literally, you need to understand that authorization rates, customer experience. Literally, what is your average cart value? That average cart value, correlates to a FICO score, and what does that customer really need to transact more business? So how do you abandon cart? Or how do you eliminate abandoned carts? Well, you kind of create a very special path to kind of align all those factors so that your customers go in with the highest possible ability to kind of complete that transaction. And that's what I think the benefit for merchants is. It's not picking this or that. It's really understanding their customer and what they need to do to complete that transaction.
Good. So Barclay, with Momnt, when you're doing lead gen, when you're looking for prospective new partners, new customers, are you, it's a little bit of a trick question, are you getting feedback and you getting requests from merchants? Are they in, what division of the company are they in? And the reason why I ask is, are they marketing that are coming to you first, or finance?
No. So we'll generally sell them through finance. Finance is generally how we'll get into a company, especially an enterprise, and it'll be an initiative that comes from their finance team because they don't have access to the data or one of those major pieces that frankly is a core function they want to own. And so that's generally how we'll see the catalyst for an introduction with someone like us is, hey, we want to own these pieces that right now we've outsourced to a 1.0 player. We don't have any insights into X, Y, and Z, and we need those insights.
I have found often that it starts with marketing, but then finance takes over.
I think it depends on the size of the organization. Okay. I think in smaller organizations it's finance, and maybe it's finance led, and ultimately there's a financial decision maker. But in other organizations it's marketing, because marketing is empowered to drive traffic. They're looking to drive transactions. So they're looking for, how do we do that? And again, it's knowing their customer, providing the tools that customer needs to complete a transaction, and really kind of segmenting these cohorts of buyers and really pinpointing, hey, where's the gap that I'm missing that can ultimately create, 10%, 20%, 30% more lift in cart values, but also transaction values.
I think it's great when the value prop can solve for that spectrum, because that has been my experience, is that someone on the lead gen side is looking for ways to do this, and then the finance team says, oh, but wait, we want to control but the partnership and the data, and they want to have it a little bit more.
But it's the beautiful battle of finance and marketing, sales and marketing that always exists in every company.
I'm glad. We are about 7 minutes before cocktails. You guys have been so good. But are there any questions from the? Yeah, go ahead.
Yeah, so you guys both talked about how regulation can improve the space, but you also mentioned how AI is kind of a great space for banking. Is there any fear in the industry of over-regulation in certain areas? And is there a path for fintechs to navigate around that?
Yeah, good question. I mean, come on, fear of over-regulation, of course. I don't want them anywhere, but we recognize that they're there for a good purpose. Yeah, I mean, I guess that's kind of that's the gray area that we're in. Is how do you not under-regulate and not over-regulate and find that kind of happy medium? And it's never that way. It's always either to the left or to the right. We're happy to find that balance, but it's I don't know what else to tell you, but there's AI and all these tools that are coming out are just going to be fantastic for us to just start again identifying these unique cohorts and marketing specific products and kind of terms and conditions to those cohorts that will enable better sales.
Maybe more bankers will go to work at fintechs.
Yeah.
Given that experience.
No, I think it's necessary. Just expanding on that, I think it's absolutely necessary. I think that we should embrace it. I do think we're going to be overregulated, but it's a natural pendulum that swings back and forth. And so I think for one, it provides clarity. It allows us to innovate in a way that we know the boundaries on, which is really important, right? For entrepreneurs, I think giving clear boundaries, where you can go and where you can't, is very important for innovation that we think is going to be aligned for where we go as a society. Without those boundaries, where you have pure gray space, you're just creating opportunity for bad actors, frankly.
Yeah, and I would say, as a global company, we also struggle with different regulations in different geographical areas. So the United States has something, APAC has a different regulation, Europe. Even state by state in the U.S. So that's another struggle that over-regulation has. Is that there's never consistency or standardization.
Question: Will there be the opposite, where at a point of sale you can say, "I'm going to take this discount for paying now"? Is that coming down?
Starting here.
Yeah,
Some places start.
I don't know, at the risk of sounding like, if I go buy a pack of beer, I get a cash price and I get a credit card price. I mean, it already exists. And that's just a decision that merchant has made to appeal to a certain cohort of their buyer. So yeah,
I think APR to it. They are paying less. They can,
I was going to say, really what we see is the opposite of that, where they'll, essentially sell products with a zero loan, where that consumer pays zero interest. The merchant kicks up a couple extra bucks to close that business. But again, offering that zero loan when the last 5 years you've seen the S&P ripping at 5%, they're like, hey, this is free money, right? So they've been promoting on this. I would say it's like the opposite end of the spectrum, where they're almost trying to get you away from cash, frankly, because they can upsell you more on a 0% loan where you have 24 months to pay it off.
You opened the door to 0% interest rates. So I have to ask, are you seeing a trend or are you seeing a possibility for interest rates increasing at such a rate where consumers will be disincentivized to take this pathway?
Certainly, we're there. Yeah, we're absolutely there. The cost to the merchant for a product of that sort right now is prohibitively high in many cases. You're still going to have folks who use this where, again, they have margins that are wide enough. I'm thinking jewelry here, where they can actually, take that sort of increase in cost to the merchant.
There's a make this work for everybody.
But I think that's where the big banks and the big lenders come in, because their cost of capital is so much lower than other organizations that are providing the fintech. So there'll be someone to come in and fill that void because there's an opportunity.
It's still treated for things.
Yeah.
That's where you kind of get advantage of.
That's exactly.
How would you say fintechs benefit banks within this ecosystem? Why would a bank need a fintech to be that bridge between themselves and the merchant?
Yeah, there's massive strategic risk of being with just one bank. So all the enterprises we talk to, when they think about the back end, they need multiple funders on that back end. Because again, if you're a large enterprise, you're funding $1 billion, $1.5 billion a year, you're definitely not going to be tied to one bank. You're going to have a minimum of 3 or 4 to fund that volume. Being able to control that, being able to dictate those terms, being able to benefit from spreads as well. Right. All of those things are offloaded to that enterprise with this technology versus before, they have no say over that. They have no ability to do that, frankly.
Yeah, to give you options in underwriting and spreads is the key there. So.
It's, I guess, maybe a bit of a selfish question because my in-law works for a regional community bank, but you guys keep talking about big banks. So what is the role of regional community banks in this network?
I'll take that a little bit. It is there, but it's responsible partnering because banks, it's not just banks, but you have to make a decision. Are you going to build the technology or are you going to partner with somebody? And I can just tell you, building it is monumental to get through. In any large organization, it's faster to partner. But when you are a bank, your partners matter. So if you're, let's be honest, most banks do not do the in-house acquiring, right, with the merchants at the point of sale. They're partnering with somebody else anyway. So it becomes, the importance becomes on how are you acting as a partner. So community banks will have it. Community banks are the backbone, right? Like they're so important, but they don't do everything, even though it seems like they do. They don't do everything, they outsource. And this will just be another outsourced partner. They just have to do it smartly, otherwise, because they're on the hook for complaints.
I think that just, to your point, I think you're also going to see where large issuer acquirer processors come down and they're swooping into that space where they can provide kind of that bundled solution for, community, regional, and smaller banks to fill that void, fill their pipeline as well.
Yeah, just wondering how much generative AI is being incorporated into these products at this stage.
I think a lot. I think it's going to be increasing more and more and more. I mean, generative AI is just it is the decision engine, and it's going to be smarter and smarter. And again, I talked about personalization. It's going to be able to kind of identify that personalization in a millisecond and be able to offer up that unique offer that will enable that transaction.
You still need the regulatory framework. Frankly, I maybe don't see it as much as you all do because where we're at, we're still very hesitant to touch a lot of that stuff because the banks aren't touching it. I think there's a place for it certainly, but until you see true regulation that provides clarity on generative AI, many different AI methods that are deployed within our industry, I think you've got to tread very carefully there.
Yeah, but also think there's a big space for it in fraud prevention. I mean, that's really where I think it's being utilized very quickly right now.
And how about using those data streams to train your own large models? Is that, I guess that's happening.
I mean, we use generative AI only in marketing right now. So on the credit side, we're not leveraging generative AI in a capacity that would be, really what I'd call any sort of AI, frankly, on the credit side purely. Marketing-wise, though, it's, we only have...
I was going to say, marketing-wise and fraud detection is where we're using it most.
Customer service.
And customer service. But I would say fraud detection is really where we're driving as much as we can into.
I think that's like a blanket, before we move on from that one, fraud is where AI is applied today very effectively, and I think that there's a massive space for that in fraud. That is some place where we leverage it, but I think that is a place where, again, you're not going to have that same sort of regulatory headache that you would in credit or someplace else.
Stop sign.
Thank you, everyone.